Are futures prices expectations of future spot prices? Well, I don't think I've ever encountered an introductory level book on derivatives or futures that defined futures prices as anything other than the market's expectation of what spot prices will be as of the futures contract delivery date. Now, as we'll see, where arbitrage pricing holds, the answer to that question is clearly no. And even where arbitrage pricing doesn't dictate the points along the forward pricing curve, that is at best a questionable contention. Hi, I'm Doug Carroll for Insider's Guide to Finance.com with the first in a series of videos on the concept of forward pricing. And since this is a fairly involved topic, there's going to be a series of at least 4 videos. This is the first one, which will focus on the concept of forward pricing. The second one will focus more closely on the forward pricing model, the so-called cost of carry arbitrage pricing model. And then there'll be at least 2 additional videos, one focusing on the forward pricing of financial futures and forwards, and the other on the forward pricing of non-financial futures and forwards. Let's begin the discussion now by introducing the concept of a forward pricing curve. Now, that might seem a strange formulation to those not familiar with the concept, so let me describe it by analogy. I suspect many viewers are likely familiar with yield curves. And the forward pricing curve is similar, although in a slightly different context, as we'll see. So, of course, a yield curve is nothing more than a plotting of the yield to maturities on bonds with different times to maturity. Yield being on the vertical axis and time to maturity on the horizontal axis. So by plotting the yields on, say, 1, 2, 3, 4, 5, and so forth years to maturity bonds, and then drawing a line that connects the dots, voila, we have a yield curve. Well, a forward pricing curve is similar, though not exactly the same. To diagram a forward pricing curve, again, the horizontal axis is going to be labeled time, although in this case time to delivery rather than time to maturity. But now the vertical axis, at least for things that trade on a price basis, would be the price. So in other words, by plotting the prices on futures or forward contracts with different times to delivery, and then drawing a line that connects the dots, we'd have a forward pricing curve. Well, what's likely the shape or slope of the forward pricing curve? Is it likely to be upward sloping, showing higher and higher prices the longer the time to delivery? Or the price is going to be lower and lower over time, thus indicating lower and lower prices the longer the time to delivery? Or might we have some odd kink shape or sine wave function or something like that? Well, as we will see, all of those are distinct possibilities. But one of the factors that will at least heavily influence, if not in fact dictate, the range of possible prices for the different deliveries will be cost of carry arbitrage pricing. So what are the factors that will dictate or at least influence the points along the forward pricing curve? Well, those factors are typically described as either the carrying charges, at least that would be the phrase used for non-financial futures and forwards, or the cost of carry, the more typical phraseology encountered when looking at the forward prices for financial futures or forward contracts. Before introducing the individual components of the carrying charges or cost of carry, and then moving from that into a discussion of the mathematical formulas that quantify how those factors impact the relationship between spot and futures or forward prices, it might be helpful to have a conceptual basis to provide a bit of a framework for understanding the connection between those factors. Consider first an extremely simplified version of what we'll see in more detail later when we consider the cost of carry arbitrage pricing formula. Boiled down to the ideas that will be implicit in the symbols that we'll consider when analyzing a more detailed version of the formula, at base, what that formula says is the futures price will be equal to the spot or market price of the underlying asset plus the cost of holding a position in the underlying asset over the time until delivery. Now, This again assumes that arbitrage pricing holds, but given that proviso, a simple algebraic manipulation of the formula shows that, again, when arbitrage pricing holds, that the difference between the futures and spot price will be equal to the cost of holding a position in the underlying over the time until delivery. Hopefully that brief introduction to the concept of forward pricing will provide an adequate foundation for the discussion to come, wherein we'll first discuss the individual components of carrying charges, or the cost of carry, and then move on to a more detailed version of the cost of carry arbitrage pricing formula to try to flesh out some of these ideas and give better insight into what factors dictate the points along the forward pricing curve, at least when arbitrage pricing holds. Now, before we get into the details on carrying charges or cost of carry, I should get the basic general idea out there. First off, what are those phrases referring to? Well, the carrying in carrying charges or carry in cost of carry has nothing to do with transportation costs. Rather, it's reference to the cost of carrying, or in other words, holding an inventory of the underlying security and commodity over time. Over what time? Well, of course, over the time until the delivery of the futures or forward contract we're trying to price. Now, what are the components of the carrying charges or cost of carry? Well, for the non-financials, as you see, there are potentially three components to the carrying charges: storage costs, insurance, and interest. Now, I'm not saying all three of those factors matter. It depends on the particulars of the commodity whose forward price we're trying to establish. So let me describe them in general and then talk about exceptions, if you will. So storage costs. Naturally, many commodities are bulky and therefore they're going to be expensive to store or hold. Think of things like crude oil or soybeans or copper. Naturally, something with that much mass is going to be expensive to hold on to. So the cost of storing the commodity from today, when the spot price dictates value, until the delivery date of the futures or forward contract will be one of the factors that influence forward prices. The second one, insurance. Now, we're talking here about insuring against damage in a property casualty sense, because many commodities are dangerous to handle or store. And so consequently, insuring against that expense is a valid cost of doing business. Now, of course, one doesn't have to buy insurance, but we're not talking about the commercial decisions of individual market participants. We're talking about the economy-wide factors that will influence these prices over time. And just to be specific about examples, obviously the underlying commodity for the energy contracts like crude oil or its refined products, natural gas. Obviously, they're quite volatile and therefore potentially dangerous to handle. And of course, there are occasionally catastrophic events that impose costs on participants in that market. But even some commodities that might not seem obviously dangerous to handle have a number of risks associated with similar potential problems. Believe it or not, grain dust is quite volatile. So nearly every year you'll hear about some explosion at some grain storage facility because there's a poorly ventilated warehouse or elevator. Those big silo-looking things are referred to as grain elevators. You'll have a poorly ventilated warehouse or elevator. The grain dust will get trapped inside, a spark will set it off, and kaboom. So where there is danger involved in holding or handling a commodity, insuring against that loss is potential loss is a valid cost of doing business. Now, those first two items, storage and insurance, may or may not apply because there are many instruments related to forward or futures contracts that don't have any physical bulk. For instance, electric power is not a storable commodity, so storage fees wouldn't enter into the forward pricing of electric power. Or they even have futures contracts on ocean-going freight rates. They're traded on the Baltic Exchange in London. Clearly, space on an ocean freighter is not a storable commodity. You've either rented your ship out this period and you're generating some income, or it's sitting at anchor. And also, insurance may or may not apply. Because again, remember, we're talking about insuring against property casualty type of damage. For a while on the Chicago Board of Trade, they traded futures contracts on pollution emission rights. Well, even though the pollution emission trading scheme never got really up and running in the United States, they trotted out a futures contract in anticipation of that market developing. And clearly, pollution emission rights can't blow up in a physical sense, and that's the sort of insurance we're talking about there. So while either of the first two of the three components of carrying charges may or may not apply, the third one always does, interest. And that's because there is going to be some value tied up in the position, and an interest expense, whether it's an explicit financing cost or an opportunity cost of capital for wealth tied up in one of the underlying positions, is potentially always going to have an impact on the value forward in time. How about financial futures? Well, with financial futures, the first two of the three components of potential components of carrying charge, as we earlier described, clearly wouldn't apply. Because financial instruments, even if they have any physical embodiment, like in a paper certificate, are not going to be expensive to store the way an inventory of crude oil or copper would be. And financial instruments can't blow up in a physical sense. So the only one of the three carrying charges we identified for the non-financials that apply to the financials is interest. Interest expense, again, as an opportunity cost of capital or a financing cost. But there's another component that enters into the consideration when we're talking about the cost of carry. And that is, many financial instruments provide income to their holder. So consequently, the two factors we have to take into account for cost of carry forward pricing of financial futures and forwards are an interest expense metric and income on the underlying or related security or commodity. Because on a holding of foreign currency, naturally there's the potential interest income, assuming interest rates are positive. On bonds, the instrument underlying fixed income or interest rate futures or forwards, again, the underlying would generate some interest income to the holder. And on equity futures or forwards, if the underlying is a single stock that pays a dividend, or an index futures or forward contract, and I'm not aware of any stock indices that don't include at least some dividend-paying stocks, then the dividend yield on the related stocks would have to enter into the pricing of forward or futures contracts on those securities. So let's look at a slightly expanded cost of carry forward pricing formula. And going forward, I'll simply use the phrase cost of carry rather than dragging into the discussion both carrying charges and cost of carry, because the same concept applies, even though that different phraseology tends to be used in different segments of the market. So note the new variation of the cost of carry forward pricing formula. F equals S outside of 1 plus CC adjusted for time. That, in words, is the futures or forward price equals the spot price times 1 plus the cost of carry adjusted for the time to delivery. Now, think about the implications of those formulas, because note that cost of carry doesn't necessarily have to be a true cost. The CC in the formula, the cost of carry in the formula, might either be a positive or a negative number. Because now let's expand the CC a little bit. Now it's going to show as the futures or forward price equals the spot price times 1 plus the difference between the cost of holding the underlying, HC for holding cost, minus Inc for the income one would collect while holding a position in the underlying, where that differential between the holding cost and the income on the underlying is adjusted for the time until the delivery of the futures or forward contract. So again, consider the formula to my left, but now look at the panels above and below where that general formula shows. Because note, as I indicated before, that cost of carry could be either a positive or a negative number. If CC is a positive number, then there is a true cost of holding a position in the underlying, because that implies the cost of holding the position is greater than the income you're going to collect while holding on to that position. But note, cost of carry can be a misnomer because look at the bottom panel. It's possible the income on the underlying could be greater than the cost of holding that position in the underlying. That's referred to as positive carry. And note, positive carry implies that the CC in the general formula would be a negative number. I'm sorry to dump this sort of terminology on you, but this is the language of the business. So think of the implications if arbitrage pricing holds. That means the futures or forward price indicated by those formulas will likely be a very accurate estimate of the prices at which futures or forward contracts are trading. So when you have negative carry, that is when the cost of holding the position is greater than the income you collect while holding on to a position in the underlying. That means CC is a positive number. There's an explicit cost of holding that position. We'll note what that means based on the formula. The futures or forward price equals the spot price times a number greater than 1. Because if CC is a positive number, the right-hand side of the equation is S times a number bigger than 1. Note what that implies about the forward pricing curve when arbitrage pricing holds and the forward contracts are priced reflecting negative carry. You have an upward sloping forward pricing curve where the price of the nearby futures and forwards are trading at a premium to the spot price, and the prices of the deferred deliveries of futures and forwards are trading at a premium to the nearby deliveries. But remember, you don't necessarily have to have negative carry. There's also the potential for positive carry. And when arbitrage pricing holds and the futures or forward contracts are priced reflecting that positive carry, note the implications of the formula now. When the income on a holding of the underlying is greater than the holding costs, that means the CC in the formula is a negative number. Think about the implications of that, again, assuming arbitrage pricing holds. So that means now the futures or forward price is equal to the spot price times a number less than 1. Because positive carry, remember, means a negative value for CC. You can think of income as a negative cost. And so if the futures or forward price equals the spot price times a number less than 1, the implications of that, and again, this is assuming arbitrage pricing holds, is that the nearby deliveries of futures and forwards will price at a discount to the spot price, and the more deferred deliveries of futures and forwards will price at a discount to the nearby deliveries. Now, this is just an introduction to the concept. The goal is to keep these videos relatively short. So this was introducing the concept. The next video in the series will look at this concept in greater detail in the context of the models, and we'll talk about where futures or forward prices reflect positive and negative carry because of arbitrage pricing relationships dictating the points, at least within a relatively narrow range of tolerances around the implied fair value. But we'll also look at circumstances where arbitrage pricing doesn't hold and get into a discussion of things like the market being in contango or backwardation. I hope you enjoyed this video. You can go to our YouTube channel or Facebook page to see other videos on a range of investment-related topics. Or you can go to the website, insidersguidetofinance.com. At our website, in addition to the free video shorts, there are a series of modestly priced, in-depth training videos with running times of approximately 1 hour each that go into a number of subjects in greater detail. The website and Facebook page also contain information about open enrollment programs I will be presenting over the next few months, and my recently released book, The Insider's Guide to Fixed Income Securities and Markets.